So here's a quick thought for the day, a quick video about back of the napkin calculations for underwriting and evaluating real estate deals, commercial, multifamily, residential, whatever it is. If it's a flip, it's pretty straightforward. Whether it's commercial, residential, doesn't matter what it is. You take the after repair value, the after developed value, and you work backwards from there and subtract your development costs, your rehab costs, the acquisition of the property, whether it's land or the structure itself, and all your commissions, your carrying costs, your closing costs, things like that, and that leaves you a profit margin. So that's a quick flip formula there. But let's talk about like value add apartment buildings or commercial real estate cash flow type properties. How do you quickly evaluate one of those properties? I'm not going to use the term underwriting because underwriting is an in-depth analysis of the overall risk profile of the property. So just a quick analysis so that you can determine whether or not it's feasible and warrants a deeper look and to go into full underwriting. So you want to take the actual numbers. You want to take the actual gross income, gross potential rental income. You want to subtract out your actual economic vacancy. You don't want to use projections, and you don't want to use percentages. You want to get the actual numbers, bad debt, things like that, so that you can get to an effective gross income. Then you want to back out all your actual expenses. You never want to go off pro forma. You never want to use what the brokers are giving you. You want to get the actual T12 and any other financial information that you can get your hands on to verify the numbers, and use actual numbers, and don't buy or evaluate based on pro forma. So when you get to that actual NOI, then you just have to determine if you can support the debt and the equity payback, if you have a preferred equity return for your equity investors, or if you're using your own cash, you want to have a cash on cash return that you're looking for. So you want to get to that effective actual net operating income after all your expenses and your effective gross income, and figure out whether or not that amount of money is going to service the debt, pay back equity investors, and hopefully leave a cushion. One thing, here's a little tip for you: factor a capital expenditure reserve into your operating expense calculation. The lenders are going to do it, the banks are going to do it, and you really want to know what your true operating costs are. Capital expenditures are not an operating cost, but the reserves for capital expenditures certainly are. It comes off your gross income. And it should be included in your operating expenses. Brokers will not do that because it reduces the net operating income and it deflates the value. So I always factor that in, and it's $100 a unit, $200 a unit, depending on how big the property is. It could be $300 a unit, depending on the age of the building, the type of the property, style of property, things like that. So you definitely want to count that in. The banks are going to do it when it comes to factoring your debt service coverage ratio. So you need to make sure that that is in alignment at 1.25 or better. You want to make sure that you've got enough cash flow coming in off the net operating income to service the debt, pay back the equity. And then that will give you an idea of whether or not you need to take a deeper dive into the feasibility or into the due diligence and to the full underwriting, which when you get into the full underwriting, you're going to go into the area, the neighborhood, the competitive properties, the rents, appreciation, things like that. Now, when you're underwriting a property, when you're evaluating a property, make sure that you always look at it from the worst case scenario and the best case scenario. You want to know what your upside potential is, but you want to make sure the property will support itself, support the debt, pay back the equity, and provide capital expenditure reserves for future repairs, future capital expenditures. You want to make sure that it's going to cover all that and still have a cushion. So make sure you look at the worst case scenario, underwrite using the worst case scenario, evaluate the deal using the worst case scenario. Make sure you can cover those three things. You want to cover the debt, the equity return and or return on your cash, and the capital expense reserves. So that is a quick back of the napkin analysis of commercial multifamily properties, residential flip development, whatever it is, worst case scenario, and make sure that you can get out of there alive.